So thanks so much for joining me, man. This is Cole.Brantley. I know people are going to be kind of joining us as we roll here. I know a couple people are on now, but I just want to introduce everybody. This is my preferred lender here in the Sarasota Manatee area. Cole works for Guaranteed Rate Mortgage Company. Why don't you start off by kind of telling us a little bit about you, where you're at with Guaranteed Rate, and then we can kind of play around with some things. But I do want to say, if anyone's watching, if you have any questions, feel free to hit the question box at the bottom or throw them in the comments. I can see some comments kind of coming through, so if you guys want to chat, add any questions, feel free to, but hit that question at the bottom box if you want to leave any comments or questions for both of us. We'll go over some market stats and updates and kind of hear from Cole. So Cole, why don't you start us off and let us know a little bit about you and kind of where you're at.
Perfect. Nice to meet everyone. If you haven't met me yet, just a little bit about me. I've been in mortgage lending for the past probably 3.5 years, give or take, right around then. Prior to that, I was a retail store manager for TJX companies. So did a little bit of that, had a lot of different experience with customer service, everything from that standpoint. I'm originally from North Carolina, so I still actually lend up there as well. That's a good thing about lending, get a little taste of all around.
That's really nice.
Yeah, it can be, but you can definitely run into some headaches too with some different things in different states. So I'm a father of one. I also have one on the way, due November 14th. So I have a boy right now, got the girl coming, and then we are done having kids. Absolutely.
Super exciting. So tell me a little bit about Guaranteed Rate. I mean, you've been in the Sarasota market here for a while, doing a lot for a lot of different realtors in our market and outside our market. And you recently switched to Guaranteed Rate. Tell us about that. How's it going? And how's that company able to serve us? Because I think for me, I see them as a bigger brand. But I know you as a local guy, as the guy who's in the market, knowing the realtors, knowing the people, kind of the situation. So tell us how that kind of merged and come across, and then we'll kind of get into some fun stuff.
Absolutely. So one of the best things, obviously in my past, I was with a different company, and we recently, this year made the move. And the reason why we made the move was simply because Guaranteed Rate offers the biggest platform. They offer technology, they offer support, they offer so many advantages to myself and my clients that it really made a big difference. One of the things, that we can get a little bit worried about, because you don't necessarily, a lot of people see a small bank and they get worried because it's a small bank, does the person only work 9 to 5 and stuff like that. And then they see something like Rocket Mortgage where they're like, is somebody getting, $50 to work on this loan? Will I ever hear from them? Those type of things. What's nice is Guaranteed Rate sort of meets you in the middle. And what that means is we're not a small bank in the sense that we have flexibility. We have tons of loan programs. We have different options. I'm available around the clock. Whereas, I'm not a 9 to 5 person. If you call me in the evening and you have an urgent question, you're going to hear from me. And then we have the technology advantage and the big ability that a Rocket Mortgage would have, right? Where we have those technology where you can link, assets, you can link income, you can do all of these things to make the home buying process as easy as possible on yourself. So that's what the cool part about it is, because you don't want to be too small, and you also don't want to be, to where you're so big that you forget what we're doing.
And I think we've seen that shift a lot with mortgage, lenders and stuff like that. The small shops have kind of, with the shifting market and everything, they're more relationship based. So we're seeing them kind of still around, where the big ones are kind of shutting down departments and stuff. So obviously that kind of gets us into the market now. So tell us about what you're seeing in the market. I know we were talking a little bit earlier when you said July was dead, which, maybe June was dead, the beginning of July. So tell us what you're seeing. I have some crazy kind of stats that are mind blowing, to be honest, in terms of where we're at in Sarasota and Manatee County. But let me know where you're at and where you see rates are, because they're pretty low now.
Yeah, so Dan, so the thing about it is, I think now that we're about to experience the kids going back to school. So everybody gets in that vacation mode in that June, July, and maybe the moving process is put on the back burner, or a lot of people decide that they were going to wait out the housing market and are seeing that that's not going to change. The interest rate perspective, honestly, forecasts and everything, can be thrown out the window at this moment. We're in unprecedented territory. And so what that means is nobody can logically tell you exactly what's going to happen in the near future, in the distant future. What I can tell you in the recent history, we have seen interest rates climb, obviously record highs in a single day. And then we've seen them level out. So the last month, we've been a lot more level. We haven't been as crazy with the dramatic rises one day, dramatic falls. We've been a little bit more leveled out with still some volatility that's not usual for the market. And what that means is basically what I advise any client, lock your rate. There's no reason to play with it. There's no reason to wait on it, because while we aren't necessarily can't predict that it's going to continue to increase rapidly or anything like that, I would still rather protect my client in case that happens. Most of the bigger companies, including us, have float down policies. And what that means is basically if the interest rates drop a certain margin, you're protected. Even if you're locked in, that means that they can actually float you down to a lower interest rate with no cost to you. Whereas if you don't lock, you're not protected. So those interest rates jump or rise, then you're going to be in a world of hurt. So we've definitely seen better interest rates probably this week and last week prior to than what was prior in like June. Now we're still talking interest rates, for a prime candidate, still in the mid to low fives, right in that range on a conventional loan. Government loans in a similar spot, and that's just for primary residences.
And now give us where's your credit score on that? Would it fall in? Because I think that's the hardest thing when talking with clients that come in to you, is that there's no significant flat rate for anybody. So when you kind of judge these low fives to mid five, where are credit scores at? And I know there's 3 credit scores. So which one should we be looking at, and where should we plug into to kind of know where we're at with these numbers?
Absolutely. So my advice is always going to be to a consumer, get with a mortgage loan originator, right? Get with me, fill out an application. And the reason being is, while the credit score is the most focused thing when we talk about interest rates, it's not the only factor. In fact, there's other keys that impact it just as much as an interest rate. Something called loan to value. Loan to value is basically the percentage of loan amount versus the purchase price, or the amount down payment that you're putting down. So realistically, right now, if I'm talking about like a prime borrower, that's always going to mean a 740 credit score and higher. A lender, we go by FICO 6 score right now, right? Other lenders there's different variations from lender to lender. There's different people that look at different things. I will advise you, Credit Karma is probably the worst thing you can look at as far as being able to tell what your exact score is. What it is good for, though, is tracking progress. So if you're working on your credit, it's going to tell you you're going the right way or the wrong way. However, it's not going to be a metric that we can use to qualify you. So that's why I always say, if you really want to be dialed in, get with a loan officer, get with me. Let's take a look and let's get you dialed into your rate, because your rate isn't going to be the same as my rate. Dan, you got that great credit,
Yeah. So now tell me, with someone getting in with you and asking about, how is that going to hit their credit? If they have to fill out an application with you, and do they have to let you know with all your bank statements, like what's going on with that process?
Absolutely.
Because I think that the Credit Karma, I think a lot of people go off of that and say, hey, I mean, I know I do. I look at it and say, hey, look at, well, this is this, or, oh my goodness, look what happened. So I think that for me, knowing that may not be the best, what are you said sign up for it. So how hard of a hit is that going to be to me?
Yeah. So, so honestly, there's no definition for every person that's going to be like, A or B or, X, Y, or Z, anything like that. Right. So for you, it depends on how many inquiries that you're getting. If you're going around, you're shopping credit cards and you're shopping for a car and this, a credit inquiry is going to hit you worse. However, it's also one of the lowest impactful things on your credit score. So typically what I tell people is to expect a 10-point hit. It could be worse, it could be better, but that's probably the range. What I always say, though, is it's better to take that hit now and let's solve those problems at the beginning than wait till longer, right? Because then we create a stressful environment for a client that always what happens, Dan, we've been there Saturday afternoon when the client that, was just looking around and they'll let me know when they're ready. What happens? They find the one. Then we're scrambling and it might not even be their credit, right? It might be something to do with their income or things like that. But if we have time ahead and we can problem solve, because you just never know. I mean, the weirdest things come up on people's history, and you don't know what's going to be on there until you actually let somebody look at it. So that's always my recommendation. Now, as far as being able to tell you what rate you're going to get in those things, that is for the most part a credit pull, and then also being able to figure out your financial standing as far as from a money that you're going to put down perspective. Because if I know, hey, I'm buying a primary residence, right? And obviously what you intend to do with the property is a huge factor. Primary residence is going to be way different than an investment or a second home. And I know we had went over some questions earlier. Someone talked about non-QM, totally different ballpark. So we want to understand what you're trying to do. We want to pull your credit to make sure that we know exactly where you're at. And then we want to know what you're going to put down. That's going to give us a really good idea of where you're going to be today. Now, that's the key, though, right, Dan? Because for the most part, where you're at today may not be whenever you're going to buy, unless you do like a lock and roll program, which we have, which are usually good to protect you against long-term, within the next 120 days, if you're going to buy, that will protect you from it rising interest rates then. So that's really
when someone does this app, how long will that kind of lock? I mean, like, obviously not everyone wants to go through this if they're 6, 7, 8 months out, but at the same time, they might not know where they stand. How long kind of does that stand with you, or that conversation?
Yeah. So your pre-approval is going to be good for 120 days. And the reason why it's 120 days is because that's whenever an underwriter will expire your credit report, right? So you have to have a credit report pulled within 120 days. So that means that pre-approval is good for them. What I tell clients, though, because there's going to be a different clients, right? If you have a feeling that there might be something there and you're 6 to 8 months out, it's better to go ahead and do it. Because we can do things like credit repair. We can do things like, we have programs that we can put in different things that you would pay off and the amounts that you would pay down, and it would tell you what it's going to do to your credit. And that's a good thing to know 6 to 8 months ahead of time, rather than, the week you want to go shopping. So it really depends on the client as far as that goes. Now, what I'll say is your credit report expiring with me, what I'm going to advise you is I wouldn't necessarily then go ahead and pull a credit report right away, right? If nothing's changed in your life, you haven't bought a car, you haven't, got new credit cards or anything like that, then that's fine. We can continue to work off of those numbers. It's if you notice a dramatic change in your credit, that's when you need to let us know. Or if you decide, hey, man, I just couldn't say no to that Mercedes anymore, I had to go out and get it. That's whenever you have to let us know. But always remember, buy that stuff or get credit cards after you close. Don't bother with it before you buy a house.
Yes. So you talked a little bit about down payment in there. And I think that is, other than rates right now, I think that is the biggest thing that people have in their minds. I think that everyone kind of thinks it's 20%. I mean, you talk to parents growing up, everyone's, save your 20%. And I do think that there's a big fear of your mortgage insurance and having that there. So walk us through, because obviously many people do and do not know about FHA, but at the same time, there's some things that kind of butt us up against that with condos, and it's really only used for certain scenarios. So we don't need to go deep in products or anything like that, but how much of a down payment would we need for a home in that $400,000 to $500,000 range that we see here in Sarasota, Manatee County? That is like our somewhat of a range of our entry level home here that we're seeing. So what would that be at 20% to get the best rate, or could we, because you have a lot of people moving, so there's a lot of cash up in the air and there's families. So tell us more about, what can we do playing with down payment? Maybe the home needs work. So tell us more about that.
Okay. Yeah. So, I mean, there's a lot of options. Like that definitely is one of the biggest things that people think, right? I get asked all the time, I just don't have enough money for the down payment and stuff like that. There are programs like, so a conventional loan, a lot of people think conventional means 20% down. It absolutely does not. You can go as low as 3% down on a conventional loan. That doesn't mean everybody can, right? You have to be approved for it. You actually have an automated underwriting ran. Right. And that'll basically guarantee. So that's why I say get pre-approved. And then if you have those questions and you want to know, hey, that's a good thing to ask, because a lot of times a client will just come in and they'll put in a down payment or something like that, where they might max out all their cash on a down payment without realizing there's closing costs involved.
Yeah.
So it's a good thing to have if you're working with a lender or something like that, and they're not asking the questions of how much you're comfortably wanting to spend out of pocket. You're working with the wrong person, simply put, because last thing that we want to do is stress somebody out and make them just, scrounge every penny they have. We want to make sure that we're comfortable. But yeah, conventional loan as little as 3% down. FHA, so that's the thing. In the past 2 years, government loans have been very difficult in the state of Florida to compete. And honestly, for not great reasons. They have maybe a negative connotation from past experiences with people where they think that a VA or an FHA buyer may be a less qualified buyer. That's not always the case. And definitely a lot of times there's scenarios that are easier with FHA or VA or even USDA that wouldn't be the same with a conventional loan. So like an FHA buyer can go as little as 3.5% down. And what's cool about that is because a lot of things like, what's the big thing right now, Dan, investing, right? Everybody wants to get a duplex or a triplex or a quadplex, which is great. Everybody's turning into a real estate investor. And it's exciting to see people build that wealth. Well,
Yep.
the cool thing about that is with FHA, still 3.5% down. With a conventional, now you're going higher. Now you're talking at least a minimum of 15% down, but realistically, with rates where they are, you probably would have to be to 20 to 25% down before you would get a rate that would make sense.
So let's pause that right there, because this is super interesting for a lot of people, I think, that reach out to me and say, hey, I want to invest, but I don't have 20%. Now you're saying that FHA, we can get into what type of properties? Because I know with you, we've dealt with a lot of FHA, with condos that don't come out, and the FHA doesn't support the condos. So Absolutely. What are these properties? Because here in Sarasota, we're in Vacationville. So I think that it's a big thing where if you can get into a single family, rent it out on Airbnb and use it, build the equity, that's awesome. So tell us about how do we get an FHA? Because isn't, a lot where I know the difference, but most people would say, isn't that first time home buyers?
It's absolutely not. So
exactly.
you can only have one FHA property, right, at a time within 100 miles of each other, right? So if you purchased originally up in New York, right, you bought an FHA property because, again, so that's how I bought my first home was FHA, right? Because traditionally, and you're absolutely right, everybody thinks it's first-time homeowners. It's not. It's not. It's just a government loan, right? So it's not. You don't have to be a first-time home buyer to use it. And you can use it more than once. Now, the key is you can't have two right on top of each other, right? They won't give you two with that. But I've had clients that lived in New York on an FHA loan, and they moved down to Florida, and they got an FHA loan down here because it was separate. It was a far enough distance that FHA is okay with it. The other key to FHA is it's always got to be a primary residence, right? So when I talk about quadruplex or triplex, something like that, the expectation is that you're going to live in one side of it, right? So you can rent out the other two. That's perfectly fine with FHA, perfectly acceptable. But you have to occupy at least one unit. The other cool thing about FHA is now there are loan limits, right? So it's like around 420,000 right now in our area, Manatee, Sarasota County. If you go into more higher end areas, more expensive cost of living, that will actually increase to meet the cost of living. The other cool thing about it is when you go to a duplex, because the thing is, even at 420,000, Dan, can you find a quadruplex in Bradenton for 420,000? Probably not. No. Or if you can, you might not want to live in the one side. So so realistically, the cool thing about that is there's tiers, and you can actually, the cool thing is FHA with any lender. You can go online and Google conforming loan limits for a quadruplex and find it in your area. And they go up significantly higher. We're talking the 800s, almost 900,000 in some areas, potentially even more. So that's something to keep in mind as well, is that allows you to increase your buying power as well, should you get. And the cool thing about it is you get to use the future rental income of the other units to qualify.
So how are they getting that? Are they pulling from other rentals that they've had in the past for Airbnb? Because I know our area is crazy. I mean, you could see some rentals off of CS Key. You're not even on CS Key, you're just in regular Sarasota. So for someone that may be into the house hacking or getting into the beginning of investing, if you can find this and live on one side, or maybe the home has an accessory building in the back that you could Airbnb out. I mean, here's some of the things you can still get that 3.5% on that.
Correct. So that's a good call too, Dan. So Airbnb, one thing about it, regular lending is not recognizing it yet. So for example, whenever I talk about, getting income to offset by those other things, it has to be long-term lease agreements, right? So I know you're thinking like, how can we determine that? Well, typically, a lot of times, a realtor like yourself, Dan, can pull up some comps in the area, maybe of those similar floor plans and what they cost. And then we can estimate with that. But then what's going to happen is whenever you go to have an appraisal for a property like that will have to have called a rental fee schedule. And basically what that is, the appraiser is going to go back, they're going to verify rents in the area, and they're going to give you an estimate, just like they give you that estimate on the house, the worth of it. They're going
so instead of a value of the home, they're actually giving you a rental.
Exactly. Correct. So now that value is the maximum we can use towards qualifying you. So if they say, hey, you have 4 units, excuse me, and those 3 units would rent for $1,200 a piece. You just created $3,600 in future rental income that we can use. You don't have to have a lease agreement in place yet. Don't have to have, deposits or anything like that. That's considered future rental income, and we can use a portion of that, usually 75% for occupancy, to go towards that. So that'll help you qualify, for that property.
And then that's like pretty much, if someone found a property like that or came to me and said, hey, Dan, I'm interested in this. How can we go from here? It's pretty much just talking through, knowing those comps and letting you know the address and kind of seeing where that person lines up for. All right.
Absolutely. Absolutely. And as a lender, whenever I go to qualify someone for that property, I'm just going to take a quick look online and see what I can find for rent in that area. And I'm just going to throw a ballpark guess out there. I'll usually be on the low end, because I always prefer to have some room for error than rather have, us walk a tightrope. But yeah, we go ahead, we look it up. And all I'm going to do, and again, this is a good conversation. Again, you have to have with the lender, because if I don't know that you're looking at this type of situation, it's a totally different qualification process. If you're buying a house by yourself without any future rental income, it's significantly less that you're going to get approved for than if you have that income to offset it.
Yeah. That's huge. Some of the questions that we got, here's one from our local other realtor, Jesse. Did you ever find out when the first mortgage was?
I did. Jesse, thank you for that.
Let's hear when the so we have another realtor here in Sarasota, and he sent in the question, and he really wanted to know, what was the first mortgage?
Absolutely. So first mortgages started in the late 1700s. And completely different than what we do now. Obviously, I don't think interest rates really existed yet. I don't think anybody had got that complex as far as figuring out a payment structure. But yes, in the early 1700s, that's when you first started seeing them. And then right around the Great Depression, they sort of went away. Obviously, because banks didn't have money and nobody had money to give them. But
apparently they didn't need to fix inflation, right?
There you go. And back then, they had to put down 50%. So there was you think 3% or 3.5% might be tough, but yeah. So back then it was 50%, balloon payments, 5-year payments. It's all sorts of different stuff. But yes, late 1700s. Thanks, Jesse.
So you kind of talked about non-QM, and I think that it's an interesting market. I know. Do you deal with any non-QM stuff?
Absolutely.
Okay.
So that's a very broad subject, right? Yep.
And we don't have to get into a ton, but I know that a couple of people had questions because we run into condotels, and condotels here are where we are, whether you're in Venice, there's a couple on the island. There's a handful on Siesta Key. We have Anna Maria, Bradenton Beach, stuff like that. I don't know if there's any in Longboat, but there's a handful. And what they're condos that have a front desk that are there to rent out for either daily up to 3 to 5 days, a minimum up to 1 day, basically minimum. But they have different sets of rules, and there's a handful of lenders, qualified lenders that won't touch these. So
absolutely,
tell us a little bit about these, because I know that everybody has questions like, hey, I want to buy a unit that's on the water someone else takes care of, and I just want to rent it nightly. And I'm the one that always has to tell them the bad news that we have a 30-day minimum here in Sarasota County for anything that's not otherwise known as. So there's 2 on Venice Island that we always show people. There's a handful on Siesta Key that do uber money but fees and financing. So tell us about the financing.
Absolutely. So a condotel is probably one of the worst non-QM products that are out there.
Nice.
It's because it's not even it's like specific non-QM products. Like there's literally programs just for condotels. And the reason being is that's one of the most risky things as a lender we can do. Right? Because what happens should that market get cut down? Well, those people are all making income off of that will then cease to exist, and it's an entire building. So what happens is if the entire building goes under, what's an investor going to do? Are they going to hold on and keep making that mortgage payment, or are they going to take care of their personal house? Chances are they're probably going to let that one go. If you have an entire condo association start to foreclose, what happens to home values? They're in that condo association, they're going to drop dramatically, which means the bank doesn't get their money back. So it's typically one of the worst. Well, I say people all the time, if you're thinking of a condotel, right now, so obviously right now, if we're talking rates in the mid to low 5s, you're talking a rate close to 10%, possibly even more, depending on the actual program.
And those down payments are more than 20%, correct?
Absolutely. Usually, if you might find one for 20%, but again, that's going to be even a higher interest rate than we're talking about. But usually 25 to 30% is the minimum I would expect to put down. So yeah, so condotel is definitely a very niche product and
what are other
very
properties that
difficult.
fall under that non-QM? So when people that, you know, think, hey, I've heard of it before, how could this ever help me? What are other scenarios? And we don't have to go deep in them, just
Yeah.
what are scenarios that would have them talking about non-QM?
Absolutely. So co-ops would be another one, right? Like condotel is similar. Those are really there's also another situation in condos. There's really only three scenarios where you're going to run into, because of the property for the most part, it's going to be non-QM. I mean, there's odd and stuff up north to do with different, you know, different properties and getting to them and stuff like that, but we can go all day about that stuff. But for the most part, the three most common that you're going to is co-ops, right? Where basically the land is leased or from that standpoint, right? It's not a full title
Ownership.
property. Yeah, absolutely.
Yep.
Ownership's different, right? Then you have condotel and you have non-warrantable condos. A lot of times those get confused. Non-warrantable condo is a lot easier to handle than a condotel. And all non-warrantable condo is basically the governing bodies that operate, you know, mortgage lending. They have a specific set of guidelines and procedures that we have to follow with condos. We have to look at their books. We have to look at everything under the sun and basically determine if we feel like they are going to, you know, have a good enough basis for us to lend into. So a lot of times if they don't have enough reserves, they might have legal pending. There's a million different reasons.
And we see a lot of that in here in
Absolutely.
Sarasota County and Manatee. I mean, there's a handful of the under litigation from the builder to a lot of things like you said.
Yep.
So
Absolutely.
I mean, some of the books, that's some of the first things that we have to look at when we pull, you know, any of these investment properties for anyone. Look at the financials and see if, you know, how big some of these assessments are getting kicked in, especially from, you know, the other side of insurance right now.
And Dan, what I always tell people too, I think me and you've had this conversation a lot, is if you suspect a condo of not being warrantable, the easiest thing to do is to find agents that have done deals in there and ask them, hey, what loan did your client get? Because a lot of times we get asked too, well, in the MLS, it's actually going to show a conventional loan. It's not a conventional loan though, but that's the only thing they have to list it in there. If we had to list every product that exists, dear God, it'd be filled up with random stuff. Correct. Always ask like, hey, who did they go through? Was it a traditional conventional mortgage or was it a non-QM, like, you know, a funky mortgage?
Yeah, gotcha. Awesome. So yeah, we've seen a handful of changes here in the market. I'm going to go over some of the stats that we've seen. Obviously, we've seen a handful of slowdown. I think the economy across the country, we're seeing, obviously the media loves to pump everybody up and think the world is ending. Obviously, our market's a little bit different here in Sarasota County and Manatee County in the fact that we have paradise, man. Everyone wants to move here from the beaches to working from home to the great school systems, but also the income tax. We don't have an income tax. The property taxes are super low. So what we have seen, though, is just in the past day, the past 24 hours, we've seen 103 new listings. But get this, 104 new price drops. There's only been 54 sold. So we're seeing more price drops right now than we are seeing new listings, which we're still seeing more listings than we are sold. So this is completely different than we've seen before. It's actually pretty interesting, though. Do you know that the days on market right now are actually less than they were last year? We're 35% less days on market here. So everyone's thinking, hey, we can push the brakes. We don't have to, you know, rush. And some of these homes we're seeing in the market, some of my clients that are missing out on some places because they're moving faster. I was talking to another realtor today, and they had just said, you know, it's wild when my clients think we can wait longer and we can kind of push buttons to get a better deal, and someone comes in and swoops and gets that place. So I do think we are seeing a little bit of a different pace than the rest of the country in terms of slowdown, but we are seeing a shift in prices. But as much as we are seeing a shift in prices, I did think this one was a super interesting one. Last year, right this time, our price per square foot was $283 a square foot. Right now, it's $350. We continue to rise in that, and that stat 350 is for July. In June. July was 374, and August took a downtick to 362. So think about that and the fact that it's $80 a square foot higher. So if you're looking at a 1,500 square foot house, that'd be $120,000 in difference price between a year. So some pretty crazy things. So now with that being said, I mean, these are all kind of good things for our market. We're seeing more inventory. We're seeing price decreases, but we're also seeing the price of homes still continue going up. So as we're seeing these rates for you that you're kind of talking about, as we see them going, what is the best bet for things? I mean, obviously we see rentals going crazy, but do we continue wait? Because I know a lot of people are on, told me, hey, when's the right time to buy? What's going to happen with rates? And I know we kind of discussed in the beginning, we can't have the magic ball, but as our area continues to grow because of that, what are the best options for people? And, I have a secondary question after that is arms, and you can kind of work that in there, but let's
Absolutely.
get creative. And I want to figure out, because we are still in a growing area, people still love this area and want to move here, rightfully so, but
Yeah.
how can we get that affordable measure to get in there?
Absolutely. So Dan, my advice to anyone always is lock in the price now. Interest rates can always change, right? And what that means is, it might be hard to stomach a mid 5 right now, or if you're getting a second home, even a substantially higher mortgage rate. However, you're locking in that price right now. Because I think, as we all thought last year that it couldn't go any higher, and then we came to this year and now we're seeing it did, maybe waiting to buy is going to end up biting you in the butt.
Yeah.
And just from the standpoint of the average mortgage loan is 7 years, right? And that's not because we give out 7-year loans. The average, most of the time, it's going to be a 30-year mortgage, but the average 30-year mortgage is going to be 7 years. And the reason being is that because people are going to refinance, right? So later on, whenever the rates drop, we don't know exactly when that's going to be. The earliest predictions that I've seen would be we're predicting maybe around March next year we could see a pullback. But again, that's anybody's best bet, especially as we know as we go into campaigns and election season and everything like that. We get to
All change.
everything, from that standpoint. So my advice is to lock in the price now. Because exactly what you said, I think one of the things that even if we see a pullback around the country, what protects our area specifically from that is the demand from the outside coming in. Because you know as well as I do, how many people we've worked with from all over the country flocking into Florida, buying second homes or primary homes, or investment property. It's just,
that's literally most of my market is people that found me right off here, off of Instagram, DM me. We go through the process of video. I link them with you, and everything is all done. I mean, we have 3 deals this month alone that are all from out of state: Houston, New York, Ohio. So it's insane, but like you said, that's the only saving grace we're seeing. We're still seeing a shift. We're still seeing some properties go down, but we're still seeing the prices overall rise, which is such an interesting, standpoint where we're sitting, especially with rates raising and inflation hitting. I think that, we're sitting in a battle where I do think that, like what you're saying, is get it under contract.
Absolutely.
And I think that there may be something that a question I did have that we have a client working with right now. So now if someone got under contract, they're not in love with the place, but they haven't found their perfect yet. Maybe they want to build a place. Maybe they just haven't found that one, but they're like, you know what, Dan, we're not going to go rent. We need to buy a place. They buy. Now they're going to sit there instead of renting for 2 years. How can they now go buy another place and keep that as a rental and add to their investment rental? And they're people that, the budgets are tight, so they can afford this place and they can go afford a more higher one, but they still need that bridge loan. What can we do about leasing that home once they're on the next one?
Absolutely. So, I mean, there's so many options as far as lending, right? There's a lot of creativity and things like that. This is a big thing, and I think what's really tough for the most part is qualifying somebody on their first home, right? That's usually the hardest one to get into. From that standpoint, it becomes easier once you're qualified once. And the reason being is you have equity that you can tap into. Like you said, you mentioned a bridge loan, right? That's a great option if you're going to sell the house later. Say you want to, focus on building, like we've talked about investing, right?
Mm-hmm.
I've been on an investing kick lately, so we'll go more.
Which is awesome. That's amazing.
Absolutely. I mean, and it's a big way that, especially I think like our generation right now, Dan, is really into that. That's the way that they see to create wealth long term, right? Is through real estate. So one of the benefits is if you purchase a house and you live in it, at least 12 months, right? That's usually the expectation when you get a primary residence. Now, obviously things can change. Nobody's going to come rip the home from you if you decide that you have to move because of something else in a shorter time period. But realistically, after that standpoint, then you have multiple options of tapping into the equity for your down payment on your next home. And then we have multiple options of washing out the debt from that previous home. And what I mean by that is there's things that's called departing residence lease agreements. And that basically is, as you go to, leave this house and rent it out, maybe you're going to then, yeah, like I said, rent it out and actually bring a
Mhm.
tenant in. And so once you get a lease agreement in place, we can actually use that to offset the mortgage that used to, impact your debt to income
How
ratios.
long's our window on that? Because I know some people get a little bit worried about, hey, we're going to start looking. How much can we afford? But also, what can we tap into? So what are we talking in timelines of them saying, hey, we have a lease, we can rent our place for $4,000 a month.
Yeah.
In 3 months from now, could they still come to you and say, hey, I need to start shopping for a home? How does that keep? Because, we know that saying, hey, we're contingent on selling our home is
Yeah.
not going to work in these days. So renting it out and knowing that, that's enough for a lender to say, hey, we see the lease in place, we see what we can do with it, and go from there.
Correct. So normally it's going to be like within 60 days of closing, right? That's
That's awesome.
almost most things in lending. Whenever it comes to timeline, are going to be 60 days of closing. So if
Great.
you're looking, so 3 months is actually like a perfect timeline, right? Because basically you're gonna go on there. You can get it all set up and things like that. By the time you close, we're going to be right around that window that lease agreement starts. No underwriter is going to expect the people to be living with you while you're getting ready to move out.
Yep.
The financing aspect, like the bridge loan or HELOC or whatever you're going to tap into, right? Because if you're going to keep that property, you're probably going to look into something called a HELOC. And that's a home equity line of credit. If you're not familiar with
Yep.
it, a great tool, to tap into. Obviously, again, it's adjustable, and we didn't mention the adjustable rate mortgage. I'll touch in a second.
That'd be great. Yes.
But yeah, so that's an adjustable rate. So there's some different things. We want to make sure that we're educated on it before we dive in, full
And now
fledged.
that's money that a homeowner can take out of their current house with the
Absolutely.
equity, use as almost a
Correct.
personal bridge loan that doesn't have any
Absolutely.
repercussions other than paying it back. And then
Correct.
now you're saying with that lease, they're able to procure another pre-approval using that debt kind of cancellation, I guess.
Absolutely. Yeah, absolutely. That's a great way to put it. That's exactly basically what we're looking for in that standpoint. Absolutely.
That's awesome. I mean, I know I
Let's
have a
jump
handful of
back.
people that
Yeah,
go
let's
ahead.
jump back to the adjustable rate mortgages real
Yeah,
quick because
no,
we had
that's
mentioned
awesome.
it, and that's one of the biggest, I think, topic it's in mortgage lending right now. So adjustable rate mortgages got a lot of flack for years, right? And that's because whenever somebody hears something other than a fixed rate mortgage, they're jumping back into the bad days of the 2008, whenever basically mortgage lending caused everything, right? And that was a totally different style of lending. The laws that were in place back then were so much more lenient and so much more, I guess not consumer friendly, that consumers could be upside down on a home the moment they bought it. That's not really possible anymore, right? The way that we are. Nowadays, the keys to an adjustable rate mortgage, right? A lot of times, again, I'm in full, transparency. Literally have locked my dad into a adjustable rate mortgage for a second home,
Really.
this month. Correct. So, he's actually getting a second home down here to be closer to the grandkids and have a place to go. So,
Now, how is his rate comparatively?
exactly. So that's what I was about to mention.
Okay.
So right now, adjustable rate mortgages, the biggest advantage that I am seeing them in is in second homes. The primary homes are really not making a bunch of sense right now. They're not low enough. But for example, for his specific, and I can give an exact scenario for him. His credit score is good, like we talked about, that 740 plus, right? He's right in that range. He was putting down 20%. So it usually an ARM is going to require a little more down because
Okay.
again, it's a more risky product for a lender. It's a non-traditional. I mean, it's still a traditional product, but it's not the everyday. But his rate as a second home on that property would have been about a 6.875. Instead, he locked a 7-1 ARM. And so what that means, because again, people hear adjustable, right? What does that
Yeah.
mean? Does that mean next month my payment's going to be different? No, not necessarily. The key to an adjustable rate mortgage is the numbers that you see. So a 7-1-5 or a 7-1, it could be a 3-1-5. It could be any of that, right? And so what that means, that first number is the amount of years that it will remain fixed at the start of the loan. So he's locked into a 7-1 ARM. So what that means is for the next 7 years, his rate is going to be 5.375.
Wow.
So 1.5% lower than what it would have been with a fixed option. And then what that means is in 7 years, after that is up, if he stays in that mortgage, which like we talked about, the average 30-year mortgage is 7 years, right? So the chances are, as a responsible mortgage lender's son, I'm going to advise him in the next handful of years, whenever mortgage rates seem to trend down and they go to a point where I feel like he would be best out, that's probably where he's going to bottom out. I'm going to tell him, hey, let's go ahead and refinance you, get
Yep.
you locked into something lower that's a fix. That way you have the same payment forever on it. Or if he's expecting to sell the house within 7 years, then that ARM is as good as a fixed rate for you. You know, the
because like
questions
you
that
said,
ask,
most people are only staying in a home for 7 years. So,
absolutely, absolutely.
and I
then
think that you kind of said it in the 2000s, and I remember, I mean, I remember everyone talking bad about ARMs back in the day, and it's kind of funny talking about it. I mean, I think that in real estate in general, I think that we're going through the big rebrand of ARMs right now, because the big thing is can we save 1%? And now, what does 1% usually cost us? So if rates are at 5.125 and we're going to see them at 6.125 next month, what does that cost us on 100,000? So we can do easy math on anything, or give us a tool that we can kind of think as we think rates going up.
So for his, what I can speak to is his exactly, right? So his was a $315,000 loan, right? So on that one, the difference between those two payments was like $280, I think. So that's, I mean, obviously that's almost a car payment. It's basically a car payment, right? That's literally what I pay for a lease right now. So that's, you know, it's an insane amount. The key to the whole ARM scenario is make sure you're educated, right? Ask the right questions. You know, if you plan on this is my forever home, a 3-1 ARM might be a little risky right now, right? Because we can't guarantee what's going to happen in 3 years. And the thing about it is, and while again, now I'm sitting here and I'm like, you know, just refinance and all this, and that's great, but there's still costs associated with the refinance, right? There's closing costs and stuff like that go into your loan. So we don't want, if you're planning on that to be your forever home, you don't want to refinance more than once, ideally, right? Unless you need to later on. But so that's why you really want to be educated, right? Because there's different options. The most traditional that you're going to hear are 3-1, 5-1, or 7-1. So if you work with a lender and you talk it through like, hey, these are my plans. This is my forever home. Well, a 7-1 ARM is probably where you're going to want to be, right? So that way you have some flexibility. We have 7 years to figure it out. A 3-1 ARM is definitely a little bit more risky in the sense that you need to be planning on selling that house within the next couple of years. Or you need to be like, hey, no matter what, I've got to refinance in the next few years. So it really just depends, and it's a good conversation to have. The key to it too is like there's that one that I keep saying, because it's 3-1, 5-1, 7-1. What that means is that one means that your rate can change every year. So your rate will. So
after that 7 years, so exactly. The 7,
so
then
it's 7 years, and then the next number that would be like what. So on his is a 5. That dictates how much your interest rate can change from the original lock. So that 5 could be, you know.
So all those numbers really spell everything out about that program.
Exactly, absolutely, and you just want to make sure you're educated on that. And if you are working with a lender, or you're talking to someone, and they maybe aren't giving you, I don't know, the good clarity on it. You might want to think about just chatting with somebody else about it, just because you want to be sure what you're getting signed up for and want to make sure that you're not, putting yourself in a bind.
So we have someone in the comments that mentioned a couple of times we talked about VA a while ago. Now VA, the funding fee is a bummer, was the comment. So tell us about VA. Obviously, there's a bunch of great things in it. If you are a veteran, obviously from a realtor standpoint, I think a lot of realtors don't understand VA lending, and I don't think that they understand what goes along with it, which is a really great program. I think it's really great for the people that are kind of utilizing it. But there are some things involved. So if there's a fee, tell us why you wouldn't use VA lending.
Yeah, so VA lending is absolutely a killer tool. Especially, I say a lot of times, especially for a first home, man, you cannot beat that product as far as it goes. Because again, and so the funding fee is definitely a hot topic, right? So the funding fee is going to start out at a lower rate the first time you use it. Every time you use it, it goes higher until it caps out, right? Your funding fee is also going to be determined based off of your service, right? So you're actually going to get what's called a certificate of eligibility. That certificate of eligibility will tell us what your funding fee is. If you have a disability, from the military and stuff, you might not even have a funding fee. So that's something to ask, because you're absolutely right. It can definitely be a substantial one, right? Usually between 1.6 and like a little bit over 2%, right? So it can definitely be a more expensive thing. However, that's rolled into the loan. So the way that I look at it from this standpoint, especially for a veteran, right, is that you don't have a down payment, right? You don't have to bring any money on that side. Especially now, like today, you're not gonna believe this, Dan. I actually disclosed a contract today. They got $7,000 in closing cost assistance from the seller.
I believe it.
When the heck
we're doing amazing things this month, and it's hard for me to ever talk about deals we're working on in the moment, because you never want to talk about them. But It's been an insane months for great deals. So I believe in $7,000. That's awesome. That's
Absolutely.
unbelievable.
So you look at that from a veteran standpoint, right? If we start to move into that market, to where we can get closing costs again from a seller, like all of a sudden we're talking about no money out of pocket. That is that person literally going in cheaper than they go and get a rental, right?
Yep.
So then from that standpoint, then you have to look at, because again, like I saw Cal's comment about the funding fee. So, definitely one thing you want to remember is you're going to have appreciation, right? So yeah, that funding fee, it stinks. Realistically, that funding fee is a year or two and it's non-existent anymore. Your appreciation's already paid for it, right? So I almost look at that funding fee as the cost of doing business for a really good loan. And as far as you go to realtors wise, again, it's sort of similar to FHA, right? There's a lot of past and a lot of strict guidelines that were in the past that really do hinder, really hindered things back then, especially like when we talk like septic and well and all these, termite.
Yeah.
There's so many different things. Realistically, though, if a house is a clean house, safe, safety is the big thing with any government loan, right? If you have exposed wiring hanging up a wall, man, I gotta tell you, Dan, I'm not buying that house anyway. I want that fixed. And that's the same thing.
And most of the things, like you said, are pretty realistic.
Yes.
Like we don't want open wires in the ceiling.
Absolutely.
We don't want exposed regular interior wires on the outside. Those are the biggest things I see is like interior wiring on the outside of a house.
And with VA as well, the septic and well, right? Like a lot of times, so VA, you do have to do inspections on that, right? However, from a buyer standpoint, those are two of the bigger ticket items that you can have go wrong. I want peace of mind if I'm them, right? Like, and so I don't look at it as, I get it from a seller's standpoint. Well, you can think that's going to be, but the chances are if you have everything's operating, you have nothing to worry about. And that's what I honestly, I don't remember the last time I ran into an issue with an appraisal with a VA. It just, it's not really, it's definitely more hype than it is an actual problem.
Exactly. So we got another question a little bit earlier, and I think it's a pretty interesting one. You live up in the Bradenton area. I live down in South Sarasota County in the Osprey Nokomis area. Someone asked earlier on cities around Sarasota that may be more affordable to buy in, to buy a house. So I'm going to let you go first. Tell us about a couple spots up in Manatee that you think are undervalued areas and that are some cool areas to kind of check out, because we're in a really crazy growing time in our area. So I do think that there's a lot of cool areas that kind of have been untapped. So go for it. Tell us what are some cool areas up where you're at?
So I think the big thing with especially the Bradenton area, right? It's very much one street over is affordable, one street over is not. So you really have to be diligent if you want to live in the Bradenton area to actually break it down and look street by street, specifically in the center of like West Bradenton, right? Really look at that area. Otherwise, we're going out east, right? We're going across the interstate and we're living on some land, man. I'm getting some cows. I'm doing all that stuff. I'm getting some acreage. That's where you're still at, to where it's reasonable, right? And that's because everybody flooded towards the beaches, as you know, right? I love it. So that's probably where you're going. A lot of people up towards Parrish and Palmetto and stuff like that. That's more. Unfortunately, I've gotten a ton of practice looking at all this stuff for my father, because I think we looked at 500 homes.
I mean, it's crazy what they're building out east up there. East of the interstate. I mean, it's wild what they're building. It's definitely a little more country. With traffic, it's a little bit further, but I definitely think as well, Palmetto, Parrish, those are awesome places to look. I mean, even they're kind of building even out towards Mayaca now at this point. I mean,
absolutely.
You hear that more and more.
A lot. Yeah, Mayaca's popping a lot. And one of the things too to think about that too is new or old, right? Because I think that's a big key too. Because new, if you want new, you're doing that Palmetto, that Parrish, that Ellington area. If you want old, that's going to be more Bradenton, right? We're not building any more houses in Bradenton. There's not a lot of room for them anymore. So that's something to keep in consideration. Yeah.
So down where I'm at, it's like Englewood. I think Englewood's still a great buy. There's a lot of really good homes and area still around. It's still a little bit of an old school town, really blue collar beach town. A lot of good places down there. Northport is really growing up. A lot of great things going on in Northport. If you're fine with not being on the beach, Cape Coral and Punta Gorda, man, you can't go wrong with having some pretty cool communities down there. I know that's a lot south of here, but you know, if we're talking some budget breakers, some things going on like that, we're seeing, I mean, we talked about it, $372 a month or $372 a square foot. That's going to run you, you know, at least $600,000 for a 2,000 square foot house. So if you're looking at being near the beach, being near the water, I would check out Englewood. That's a beach town. Definitely a little bit more age. Like, you're not going to see any new construction,
Yep.
but you will see some more new construction down, you know, in the Cape Coral, the Punta Gorda area. There's a handful of really cool areas. So that one. I have one more question. We've been on here for almost an hour, man. So I appreciate your time and all that. I think we covered a bunch of stuff. Two more questions. One more is, I guess these are kind of still the same, actually. I got a question from someone. I own a business and I work for myself. Can I still get a mortgage? And then
Absolutely.
someone also wrote at the same time, a different person said, can you still do a no-doc loan? So I think those kind of, most people's age range kind of think the no-doc, the people that, you know, work for themselves. So give us a little bit of info about, you know, working for yourself. I mean, I know a lot of people work for themselves now, so tell us more about that before we get out of here.
Absolutely. So working for yourself, right? So definitely no doc loans. We can go into those as well. We have them, but yeah, absolutely. If you're self-employed, you can buy a house. So now the key to that is how hard you want to make it. And the simple put is that is, man, like anybody, nobody wants to pay more taxes than they have to, right? We're going to do our best. However, for a conventional loan, an FHA loan, for what we call conforming loans or, you know, QM loans, we're going after write-offs, right? So realistically, now there's certain stuff that counts and stuff like that. I'm not a tax professional, so I'm not going to go in and tell you how to do your
we're not
taxes
lawyers.
like yeah, we're not any of that. You know, nor do I have any desire to be. But what I will say for sure is, whenever it comes to that, is especially if you're thinking about buying, it is more important for a self-employed person to get with a mortgage lender sooner than it is for anyone else. Because I can literally go over and tell you exactly what your income is within 10 minutes of looking over your you know, tax returns for the last 2 years, and I can tell you exactly make. The other key is you have to have been self-employed for 2 years. Now there's scenarios and stuff, but I'm not going to go with the 1%. Let's go the 99%. You have to be self-employed for 2 years in that same business. You have to have filed 2 tax returns, right? Because we need to see a trend of the income. Now, with that said, if you're the person that is writing everything off, you know, and that's what it is, there are options for you. And they're called bank statement loans, or you know, 1099 loans. And basically what that means is I take the last 12 months or 24 months, depending on the program, and I look at your bank statements and the deposits coming in for a business owner, and I can generate a stream of income based off of those. Now, like you would think, you know, Dan, if it sounds too good to be true, well, there's some catches, right? More money down. It's going to be 20 to 30% down on average. So it's more expensive as far as out of pocket. However, that is a way, if you have the money to put down and you know, I'm leaving my tax returns where they're at, that's an option, right? Is to do it that way. The no-doc piece, right? DSCR, right? That everyone's all about it. And so what that means, and I'm just going to be as layman's about this as I can, because we can go into depth, and we can go into depth about it as all sorts of stuff. But basically what that is, that's for an investor, right? You're buying an investment property. The bank or myself, I'm going to qualify you off of the potential income of that property. I don't care about your income. Obviously, your credit's still going to come into effect and those things, right? There's not really a lender unless you do commercial lending that's not going to take your credit into effect. And even then, they're still taking your credit into effect, just a different way. But for that standpoint, we actually will then have formulas where we run the potential profit of a property, and then we are able to then lend off of the profitability of that property.
Really?
Where it's
so as long as they have, you know, two things, they're a decent credit score over 740, let's call it. Let's just call that the money number, 740, and a property that's can show decent
money,
income.
Right? So that's one of those non-QM loans. So you're going to be 20 to 30% down.
Okay, 25% down, stuff like that.
And that's what I always say. You know, that's typically our range, because there's some programs out there that will do 20% down. You're realistically not going to find them less than that. You might, and again, and one thing I always advise, especially investors, because, you know, like everybody's trying to make money and they want to do, you know, to make it big. if something sounds too good to be true, like if some guy on Facebook hits you up and says, I have a 5% down DCF, just let's use common sense with it. You know, there's a lot of
Exactly.
scams out there, a lot of that stuff. But yeah, those
Well, and
are
I think
two
that
options for
that's the key to it, right? If you have
yeah,
cash, you can pay the down payment, and then that's where you can buy. You're basically buying a rate. I mean, you're buying
absolutely.
into that, and that we're on the other side. We're seeing, you know, lower down payments that still make it affordable for people to go buy